Hey, everybody, welcome to another episode of the Study Wealth Podcast. The first week of trading in 2024 was one that went to the bears after things basically finished about as good as they can at the end of 2023. So what I'd like to focus on in today's podcast episode a little bit is what are the potential risks that are embedded in some of the names like Apple. And this is not to pick on Apple specifically, but it is a good name to discuss. I'm going to put on the screen share for those people that are watching this on YouTube. If you're not watching this on YouTube, but in a regular podcast platform, then don't worry, you're not missing out on anything. I'm just going to quickly talk through this. But one of the things that I think that a lot of investors have come to believe over time, and I fully understand why, is that a stock like Apple is impervious to drawdowns. And the fundamental drop or realities for a company, for a stock, particularly like an Apple or a Microsoft, probably, in my view, are not really where the risks are with potential drawdowns. They're much more liquidity being coming in and out of the system, and how investors have had to buy these stocks to just be able to participate in the broader market directions. A lot of crowding in positions, and we'll talk about that here in today's episode. But just to give you a small micro glance at this, we'll just look at last week's price action, or the last couple of weeks, actually, in this case, even the last couple of weeks of 2023, and what took Apple about, let's say 1, 2, 3, 4, 5 weeks to accomplish on the upside was erased in 3 weeks. And this is actually a pretty mild example. Typically, equities work that way. They take, X amount of weeks, 5, 6, 7, 10 weeks on the upside. And then when they mean revert, it only takes about a third or half the time to erase those gains. No different for Apple. And anyone that was extremely bullish Apple in early December is now more or less looking at a stock that had a peak to trough retracement so far of about 10%. The bigger issue that I see with individual investors, and I'm saying this not to give anyone investment advice. Remember, we can't give investment advice here on a podcast. We can only do that at Blue Marlin Advisors. That's our registered investment advisory firm, but this is just information. And so the bigger thing, I think, is that people look at a stock like chart, and a stock chart like Apple, and I'm going to refer to a long-term chart on this, and they're using a monthly sort of time frame. And if we do that, what we can see, and again, it doesn't matter whether you're seeing this chart or not, but what we're noticing is that this is a stock that really continue to have a very strong upward trajectory. What I think people forget is that even a stock like Apple certainly is not impervious to drawdowns, and typically when the drawdowns happen, they are much more severe than those people can stomach or that they remember them having been. So just going back over the past, 5, 6, 7 years, there are plenty of times when a stock like Apple drops 30, 40% in some cases, and it can happen really quickly. So a 20, 30% drawdown, what I'm trying to say, is really nothing spectacular for a stock like Apple. And the other point that I want to make before we start talking about the technicalities of how this could happen, this is not a forecast, nor is there anything bad about Apple. I think it's a terrific company. I think Microsoft's a terrific company in terms of the products they create and things like that. But if we look at if we have a long-term look at Apple, in this case, we're looking, and I say long-term, it's about 14 years we're looking back here. Even if Apple were to have a 30, 40% drop from here, it still would be in a very steep uptrend. And 30, 40% is for a lot of people who are buying something for it really in hopes of it going up more or less immediately and like forever. That's a big deal. That's a really bad time to have bought the stock from a timing perspective if one is looking to micro time the market. Just again, this is not anything against Apple. It's about positioning. So let's talk about positioning and let's talk about how all this works. Not to bring this up one more time because we're going to take a bit of a different look at it here, the dynamics of it. And I've been talking about this to our clients over the past month or so. And we all know the concentration. Apple, Microsoft, the Mag 7, it's 7 stocks. It's not index of 100 stocks or Nifty 50 stocks. We're talking about 7 names. Now, again, in my personal view, these are good companies from a fundamental perspective, but we need to think about where the risks might be if there has to be some de-risking taking place in the market. So, last few days, as I'm recording this, we had a meeting with a bunch of hedge funds and family offices up in the mountains near Davos in Switzerland. And what we were looking at was the potential risk that the concentration in these 7 names brings to the broader market when people have to sell. So the average hedge fund that we were looking at has a dramatic overallocation to these stocks, as it quite frankly should, because that's what the index is doing. The index, we all know, the NASDAQ 100, the S&P, has a huge overweight in these stocks, the S&P being a market capitalization weighted index. So if I were to buy a portfolio, an index portfolio, I would have to, just to be an indexer, to be dramatically overweighting these 7 stocks if I'm allocating to US equity, of course, that is. The question we have to ask ourselves, and it's really a very simple question, I just don't see a lot of people asking that question right now, is which stocks does an indexer, for example, someone that runs an ETF or a mutual fund that's at least in good part tracking it, which stocks are they going to have to sell the most of if there are redemptions in that ETF, in that fund, in that mutual fund, that hedge fund, whatever? And the answer is those stocks, right? So it's an Apple, it's a Microsoft, it's all the stocks that we all have come to know and use every day, our product, watches, and this and that. So from an asset allocation perspective, I cannot ignore that. Now, of course, the average investor looks at it and says the stock has continued to go up for years and years and years. And even if the stock were to only drop, and I say only, for a lot of people, this is an eternity, only drop to 130. Recording this here, the stock is now currently around 180 bucks. It was 200 bucks, 20 bucks higher just a couple of short weeks ago. And again, 20% higher. If one bought that up there on a breakout, that's 9% right off the top. And if an index bought that and someone came in with if someone were to come in, allocated new money in December towards the end of the year and bought an ETF, an index ETF or an index tracking mutual fund, whatever, that's down a lot now because of the over allocation to the stock. And I just wish people would be a little bit more sensitive to the real risks that revolve around Apple, Microsoft. Again, it's not because of fundamentals. Now, I do think there can always be fundamental issues, right? Stocks can always fluctuate due to fundamental, technical, whatever. But here we're talking about structural issues that have to do with over allocation to a few names. And again, to be very clear, these are good companies. So again, if I'm an investor, I had a dramatic over allocation to those names. I personally don't. I certainly would, though, be very concerned about that. I would certainly look to clip the over allocation down by at least 50%. So to make this a simple idea, and everyone's got different portfolios, so again, I can't give investment advice here, but if I own 10 stocks and weighted so much more Apple and Microsoft and a couple others, and then the other, well, 10's a stupid number, actually. Let's just take one stock. Let's give an example with 10 stocks, and one of them is Apple. And Apple has to be so dramatically overweight just to be part of that mock index I'm creating here. If Apple is one stock out of the same, but it's weighted like 30%, so a third of that whole portfolio is Apple. I personally, if I was in that situation, I would at least cut that in half so that it's only 15%. Because again, it's not, I think a lot of people they're concerned about a stock like Apple around its fundamentals. They're concerned about new product announcements, this and that, and who. I mean, it's such a big company. There's so much news every single day, and so many things that can affect it. But I see very few, particularly in the retail side, people self-directed, what they consider self-directed, really looking at where are the issues in terms of crowding. Yeah. I look back at the course of my career thus far, the past 25 years or so, and I look at where the risks have been typically that caught people off guard. It had to do with concentration risk. We can go back to the GFC, the Great Financial Crisis, 08, 09, right? A lot of people were in these structured products. This is more on the high net worth side. And a lot of people that were in structured products and equities that had barriers and all those kind of things. And if you don't know what that is, don't worry about it. The point is sort of over-concentration. There were a lot of people that had too many homes. Let's talk about hard assets, physical homes. How many people during the Great Financial Crisis had too much of their net worth tied up in homes they didn't live in, spec homes, whatever, right? It's typically the over asset allocation. I think the over concentration, and I think right now the over concentration is in these names like Apple and Microsoft. And however, it's very different, right? Than, for example, just looking at the Great Financial Crisis, the GFC was all about ultimately we had a problem in housing, we had a bubble. I don't think these companies necessarily are a bubble. Now, even at half the valuation, they're still going to be, I think, great companies. This is not to say the stock's going to fall 50%, but I'm just playing devil's advocate to say that the fact that these are great companies, they're going to continue to innovate, re-innovate, does not have anything to do with the stock having to continuously have to go up. If you look at, let's just stick with Apple, they continue to come up with great products, but did the company have come up with new exciting stuff? Maybe less exciting because the iPhone continues to look the same. Let's say new good software, yeah, all the time, but that has very little correlation to the stock's flows. Now, at some point, we will see, I would argue, it's impossible to think that won't these companies come back in line and their market cap concentration will come back in line. And then I certainly would want to buy them with both hands. That's, I think, an important thing for 2024 is to maybe not be overly allocated. Now, of course, I said that last year. That was wrong. But the thing is about markets is very much like I said before, they tend to take the escalator up, but then the elevator down. Very much like we saw even just in a very short term, over the past few weeks with Apple. The problem with this trade, though, that I see, is that when the elevator does go down and people have to sell some of these stocks and they have to sell those more because they're such highly concentrated, really cause dislocation in the markets. And this is not to sound grizzly bearish and be super negative about things. It's just the risks that are out there. Again, the average investor, the average retail investor that does not have an investment advisor or not an investment advisor that actually understands the market, that just is there to put them into a bunch of funds, run the risk of having serious drawdowns, much more than necessary. If all I do as an investor, whether I'm a professional investor or a retail investor or do-it-yourselfer at home or self-directed, whatever we want to classify as, if the index drops by 50% and I only draw down my portfolio by 25%, that may not seem, for newbies, that's a win, but that's a big deal. That's really good, right? If the market drops 20% and I only drop 10%, that's still pretty good. Now, some particularly newbies will disagree with that because they haven't understood, lived through the dynamics of that. The best way I can protect myself is to maybe be underweight some of these stocks, at least for right now, because of that market cap concentration risk. And again, there is a dislocation of time frame, meaning there are people that are in these trades for a long time and they risk having sometimes years worth of gains evaporated, and then they sell at the worst time. So that's the long-term investor. The other person who might think they're a long-term investor, but they're really a trader, is exactly what I talked about at the beginning of this episode. They come in, they don't ever anticipate the stock having a drawdown of more than 10% or even 5%. right? And then of course they are done. They sell at the worst spot and they're done with it. And they will continue to do that several times until they basically give up. So long story short, beware of the crowding in these names. This is a different angle to what I keep talking about or have been talking about for the past few years here and there about the over-allocation and indices. Think about what it means very logically from an investor's perspective, a fund, an ETF, if they have to take if they get withdrawals, fund withdrawals, what does that mean? Do they have to sell more or less of the apples of the world that they own than other stocks? And of course, the answer is more, a lot more. And that can cause easily 30, 40% drops in a stock like Apple. So for me, if I was overly allocated to them, I would certainly cut the allocation in half. Again, everyone's got a different situation, so this is not investment advice. But I do not want to give up years worth of gains by just not being aware of the overconcentration. So much about that matter. But structural analysis, which is investor allocations and sentiment as well, matter even more in the near term. Hope it helps, and we'll see you again in the next Steady Wealth podcast episode.